Welcome to Iron Financial. We're here to help you forge a stronger portfolio, not by chasing trends, but by stress testing the companies you're actually watching. I'm your lead analyst. Today, we are putting Hyperfine, that's ticker HYPR, directly under the microscope. This medtech company just dropped its Q4 earnings report, and believe me, the numbers are making some serious noise out there. But our job, as always, is to cut through all of that noise. We're going to examine the structural integrity of this investment. Is it built on solid ground? We'll dig into the numbers, we'll analyze the risks, and we will determine if this is a solid foundation you can actually build on or if it's just a house of cards waiting for the slightest breeze. All right, let's get to work.
And right there, that is the question we absolutely have to answer today. I'm the market skeptic, and look, when you see a number like that kind of massive growth, especially in a market like this, it should trigger two very different reactions inside your head. The lead analyst, well, he's going to tell you all about the first one, the excitement, right? The adrenaline, the possibility that you stumbled onto the next huge winner before anyone else has. But the second reaction, for a disciplined investor, has to be suspicion. You have to ask the hard questions. Is this growth even real? Is it sustainable? Or is this just a desperate, incredibly expensive launch for relevance that's ultimately going to crumble under its own weight? We're going to dissect both of those possibilities. We'll start with the blueprint the bulls are betting on, and then we're going to look for the design flaws the bears are seeing.
And there it is. That's the number. The one that's grabbing all the headlines, lighting up trading screens, and getting everyone talking. 128%. That's the year-over-year revenue growth for the fourth quarter. It's an explosive, absolutely eye-popping figure that you just can't ignore. But you know what? It's also exactly the kind of metric that gets emotional traders hitting the buy button without thinking, and it's what sends a stock soaring in after-hours trading. But here at Iron Financial, we know that a single number, no matter how impressive it looks on the surface, is never, ever the full story. It's a starting point. It's the reason we're here today, but our real work is to look behind it, to look below it, and to see what's actually holding it up. You have to remember, big numbers can cast some very, very long shadows, and sometimes what's hiding in those shadows is what matters most.
Okay, let's dive into the bull case. To truly understand any investment, you first have to fully appreciate the strongest possible argument in its favor. You have to know what the optimists are seeing. What's the story they believe in? This is the blueprint for Hyperfine success. Right now, we're going to examine the key pillars that the bulls would point to as clear evidence that this company is not just growing, but that it's building something durable, something powerful for the future. So pay close attention, because every single point we're about to cover is like a load-bearing wall in the entire bull thesis. Let's see if it's really built to last.
This right here is pillar number one, and it is a big one. Just look at the pure velocity of this growth. In the fourth quarter of 2024, Hyperfine brought in $2.32 million. Okay, fast forward 1 year, and that number has jumped to $5.29 million. That's more than double. This isn't just simple growth, this is acceleration. For a company that's still in its early stages, trying to break into a very complex medical market with a revolutionary product like their Swoop portable MRI system, this is exactly the signal you want to see. It suggests their sales strategy, their go-to-market plan, is finally hitting its stride. It shows that the market is responding. This is the engine of the entire bull case. It's telling you the demand is real.
Now that revenue number, that's just the raw material. The really crucial question is, what can you build with it? And this slide, this illustrates the second pillar, improving profitability. Look, it's not enough to just sell more systems. You have to make more money on each and every system you sell. A year ago, Hyperfine's gross margin was a pretty thin 36%. Today, it's a much healthier 51%. That is a massive, massive leap in efficiency. It tells us that the unit economics of the business are getting stronger. They're getting better at building and deploying their product, which means as revenue continues to scale up, the profits should, in theory, scale even faster. This is real evidence that the business model itself is hardening into something that can actually support long-term, profitable growth.
The third pillar is management's own forecast. Think about it. A company's guidance is its blueprint for the immediate future. And what Hyperfine's management is projecting is strength. They're guiding for their 2026 revenue to land right around $21 million. That implies 55% growth from 2025. Now that's a strong top-line story, for sure. But here's the other side of the coin, and it's just as important. They expect to reduce their cash burn by 10%, bringing it down to about $27 million. So the narrative they're selling to Wall Street, the narrative they're selling to you, is powerful. They're saying, we are going to grow faster, and we are going to do it while becoming more disciplined with our cash. For a growth investor, that is the dream scenario. So to put a solid steel frame around it, the bull case is constructed on these 4 key girders. First, you've got that explosive Q4 acceleration we just saw, coupled with those expanding gross margins. They're selling more and they're making more on each sale. Simple, powerful. Second, their overall loss profile is improving. The net loss actually narrowed in 2025, which means they're controlling their expenses. Third, the outlook for 2026 is solid, projecting continued high growth and better cash management. And finally, they've shored up their finances with some recent equity and debt deals, giving them what they claim is a cash runway all the way into 2028. From this perspective, the structure looks strong, it looks sound, and it looks ready to build even higher.
Whoa, hold on a minute. Any structure that looks a little too perfect deserves a much closer inspection. It's my job to take a sledgehammer to that pretty little blueprint and see if it actually holds up under pressure. You know, a beautiful architectural drawing is one thing. The reality of pouring concrete in the middle of a storm is something else entirely. We've heard the bull case. It sounds good. Now it's time to apply some real pressure. We're going to hunt for the hairline fractures, the weak points in the foundation, and the hidden risks that could bring this entire structure down. It's time to find the cracks. And here's the very first crack we find. And let me tell you, it's a big one. That beautiful headline-grabbing 128% growth in Q4, it's a spotlight. And what are spotlights designed to do? They're designed to keep you from looking at what's lurking in the dark. If you just zoom out for a second and look at the growth for the entire year of 2025, the picture changes dramatically. The full-year revenue grew just 5.2%. Let that sink in for a moment. A single spectacular quarter is masking what is otherwise very, very tepid annual growth. This suggests that their performance is inconsistent, it's unpredictable. You cannot build a solid long-term investment on one great quarter, any more than you can build a skyscraper on one deep pillar. You need a consistent foundation, and this doesn't look like one.
Okay, now let's talk about the cost of that growth. What's the price of doing business for Hyperfine? Well, for the full year of 2025, the company posted a net loss of more than $35.5 million. Let's be crystal clear about what this means. They generated $13.5 million in revenue, but they burned through $35.5 million to get it. That means for every single dollar that came in the front door, nearly $3 went flying out the back. This is a business that is absolutely hemorrhaging cash. This number represents the immense weight that is constantly pressing down on this company. That is not the sign of a strong structure. That is the sign of a leaking hull that's taking on water fast.
And if you think last year's loss was bad, let's look at the bigger picture. This number. This is the accumulated deficit pulled directly from their own balance sheet, $330 million. This is the grand total of all the losses the company has racked up over its entire history. This isn't just a crack, this is a foundational flaw that has been there from the very beginning. It tells us that this business model has never, not for a single year, been profitable. It's a history of burning more cash than it brings in, year after year after year. This is the historical weight that the company has to overcome, and it is absolutely immense.
Right. And the bulls, they pointed to a cash runway that supposedly extends all the way into 2028. But you know what? A runway can get awfully short when your engines are on fire. Let's just look at the raw numbers here. As of the end of last year, Hyperfine had about $35 million in cash. Their own guidance projects a cash burn of about $27 million for this year. You do the math. That means without raising more money, they would be running on fumes by the end of 2026. The only reason they can even claim a runway into 2028 is because they just took on a new $40 million loan and raised a bunch of money through an equity offering. They're not funding their runway with profits, they're paving it with debt and dilution.
So let's be very clear about the structural weaknesses here. They are significant, and they are all interconnected. First, you've got these ongoing massive losses and the high rate of cash burn. Second, this creates a critical dependence on external financing just to keep the lights on. They are completely reliant on stock offerings, which dilute the value for every single existing shareholder. And now they've added debt to the mix. That new $40 million senior secured term loan adds a whole new layer of leverage risk. If things go wrong, the debtors get paid first, and the stockholders get whatever's left, if anything is left. This isn't a structure being built with its own materials. It's being held up by external scaffolding that could be taken away at any moment.
And finally, for anyone out there who is even considering putting their capital to work here, you have to understand the nature of the asset itself. This number is the stock's beta. At 2.4, it means that Hyperfine stock is, theoretically, 140% more volatile than the market as a whole. When the S&P 500 moves 1%, HYPR is expected to move 2.4%. Yeah, on good days that feels great, but on bad days the floor can drop out from under you in a heartbeat. Investing here isn't like laying a foundation with stable, heavy granite blocks. It's a high volatile asset that requires extreme caution and, frankly, an iron stomach.
All right, So we've examined the company's internal blueprint from the bull's perspective, and we've run a pretty brutal stress test from the bear's perspective. But a company doesn't exist in a vacuum, right? Now we need to look outside the company itself. Who are the other players on this construction site? Who is supplying the capital? And what are the official warnings posted right there on the fence for everyone to see? Understanding these external forces, the big money investors on one side and the company's own disclosures on the other, is absolutely crucial to making a final judgment call.
And this is a powerful piece of evidence for the bulls. You have to admit it. You are not the only one betting on this blueprint. In the fourth quarter, some very large, very sophisticated investors, what we call whales, started building or adding to their positions. SIO Capital Management initiated a brand new position of 2 million shares. Cataleo Capital, a well-respected specialist healthcare investor, added significantly, and you see world-renowned quant funds like Renaissance Technologies and even giants like Bank of America getting involved. This is the so-called smart money. These institutions have entire teams of analysts, and their decision to buy is a significant vote of confidence. They see the exact same risks we do, but they've obviously decided the potential reward is worth it.
But let's be honest, smart money has been wrong before, many times. And while these whales are buying, the company itself is posting the clearest warning signs you could possibly ask for. This quote, you see, this isn't from some skeptical analyst's opinion or a short seller's hit piece. This is from Hyperfine's own annual 10K filing with the SEC. It's the official legal document describing their business. They state, and I'm reading directly, "We are an early-stage health technology company with a history of net losses, which we expect to continue. And we may not be able to achieve and sustain profitability in the future." They are telling you, in plain black and white, every single risk the entire bear case is built on. It is the ultimate disclaimer, and you ignore it at your own peril.
But it's not all doom and gloom coming out of the filings and the news releases. While the financial risks are stark, there is tangible progress being made on the technology, which, let's face it, is the ultimate driver of future value. The FDA recently cleared a significant software update for their Optiv AI platform. This is a critical milestone. It enhances the product's capabilities, it makes it smarter, and that can potentially make it much more attractive to their customer base of hospitals and neurology offices. Every single positive regulatory step like this is a chance to reinforce the company's competitive position and create the future revenue that could, eventually, patch up those deep financial cracks we've been talking about.
Okay, we've laid it all out. We have looked at the ambitious blueprint presented by the bulls, and we've run the brutal stress test of the bears. We've seen the smart money placing its bets, while at the same time reading the company's own explicit warnings. All the evidence is on the table, so now it is time to weigh it all and deliver the iron financial verdict. Is this an opportunity you forge ahead with, or is this a flawed design that you just walk away from? Let's bring it all together.
This final weigh-in puts the core conflict into sharp relief. On the bull side of the scale, you have tremendous potential. That explosive Q4 growth, the strong forward guidance, and those expanding margins, they all tell a compelling story of accelerating adoption and a strengthening business. But on the bear side, you have the crushing weight of a $330 million accumulated deficit and that ridiculously high cash burn. The bulls will point to the validation from institutional smart money buyers, seeing it as a clear sign of confidence, but the bears will counter with the company's dangerous dependence on debt and shareholder dilution just to keep the lights on, not to mention a stock that is inherently volatile and dangerous with that 2.4 beta. It's a classic story of incredible potential versus significant undeniable risk.
So the final verdict from Iron Financial is this: Hyperfine is the absolute epitome of a high-risk, high-reward structure that is still under construction. To call it a design for disaster is to completely ignore the real commercial momentum they showed in Q4 and the clear technological progress they're making. But to call it a blueprint for success is to ignore the glaring, massive cracks in its financial foundation. The balance sheet is not solid, the history of profitability is non-existent, but the blueprint, the technology itself, the huge market it's targeting, and its recent acceleration is undeniably ambitious. This isn't a trap, because the risks are disclosed in plain sight for anyone who bothers to look, but it is certainly not a fortress. An investment here requires a very, very high tolerance for risk and a firm belief that they can build a new, profitable foundation before the weight of their past causes the whole thing to collapse.
And that leaves you, the investor, with the one crucial question you have to keep asking every single quarter. A race is underway. It's a race against time. Can Hyperfine's revenue growth build this structure higher and faster than its cash burn can erode the foundation right out from under it? Sure, watch the revenue growth, absolutely. But watch the cash flow from operations and the net income line even closer. Because in the end, you have to decide if this ambitious structure will one day touch the sky, or if the undeniable force of financial gravity is going to bring it all crashing down. The numbers will provide the answer. It's your job to keep watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.